So when talking about accounting rules, as an accountant or as a bookkeeper or as a business, it is important for you to have a common rule. If not, it becomes difficult for you to trace business A with business B. It becomes difficult for you to understand the financial statements prepared by one accountant if you have to check through. So it is always important to understand that there is a rule that will follow. So if a mistake is being made by one accountant, the other accountant or the other auditor could quickly recognize it. Because whatever we do as accountants, whatever posts or records we make as accountants, the auditors will check. So why would the auditors understand that concept? The auditors will be able to understand that concept because they know that we are using the same rules. I told you to sit down properly. Sit down properly. So because they are using the same rules, I would know that, oh, accountant A has made a certain mistake. But it's supposed not to put this in the debit entry. It's supposed to be in the credit entry because we are using the same rules. So that is why in accounting there's what we call accounting policies. Do you understand? So here we talk about accounting rules. We said what? All accountants and bookkeepers must follow accounting principles so as So look at what I said. All accountants and bookkeepers must follow accounting principles so as to be able to track the records being made by one another. So both bookkeepers and accountants, they have to go with the accounting principles. And what are accounting principles? Accounting principles are concepts and conventions. Are you with me?
Yes.
Okay. So we'll go to accounting principles now. So continue to read, please. The accounting principles are So when talking about accounting principles, they said accounting principles are sometimes referred to as concepts and conventions. A concept is a rule which sets down how the financial activities of a business are recorded. So for the concepts, stop writing please. For the concepts, it is the rule set out on how the financial records will be made. So these are the rules that will set out how you prepare your financial statements. We call it concepts. Conventions are how we accept it. How we okay, yes, this is what we are following. We're following the principle of entity. Oh, we're following the principle of duality. Oh, we are following the principle of reality. So how we accept this principle is what we call our convention. Do you understand what convention is here? The rules are there to follow, which are the concepts. They are guidelines that we have to follow as a business or as an accountant. But how we accept these guidelines is what we call conventions. Do you understand what convention is here? So look at what they said. They said a convention is an acceptable method by which the rule is applied to a given situation. So you have accepted the guideline of this concept. You have accepted the rules being made with different situations. There's going to be a situation whereby it is duality. That means for every debit entry, there's going to be a corresponding credit entry. There's going to be a certain time you think of prudence, when you must not overstate your profit or asset, and you must not understate your losses or liabilities. They are all principles that has to be followed with different situations. Are you with me? So, as an accountant, you have to understand that there are concepts, rules, regulations that has to be followed. As an accountant, as a business, you have to understand that whatever situation you have, it is acceptable. It is for you to accept to use those rules. That is the convention. So each situation that you meet yourself is already in accounting principles. You just have to apply it. That is when you talk about what? Convention. You are set to apply these rules. You are set to apply these principles, the guidelines. Is it clear? So being able to accept the guidelines stated by the rules and regulations that you have to follow as an accountant is what we call convention. Is it clear? Concept. So let's use these are rules. Instead of saying it is the rule, let's say these are rules, okay? Yes, you are right, please. These are rules. So, concepts are rules set out on how the financial records are being made. Conventions, these are the acceptable methods to which we have to put the rules in every situation. So, all accountants and bookkeepers must follow accounting principles. That means there are principles that have to be followed as an accountant, or as a bookkeeper, or as a business. You need to follow certain rules and regulations in the course of you preparing your financial record. So that makes us talk about accounting principles. So what are accounting principles? We talk about accounting concepts and accounting conventions. What are accounting concepts? So these are rules set out on how the financial records will be made. So the rules that is being set out on how you record your financial record, or how you record your financial statement, is what we call accounting concepts. Then go to conventions. What are conventions? Rules, the methods that is being acceptable that you have to use through the concepts. That's what we call conventions. An acceptable method that has to be taken based on the situation you have as a business, or the situation you have as an accountant. That's a convention. I think it's clear. Then we have to check the accounting principles we have. We have 10 accounting principles. The first one is business entity. When we talk about business entity, remember we used to say the business must be separated from the owner of the business. So that is an accounting principle, which we call business entity or accounting entity. What does this imply? It implies that whatever you are setting, whenever you are setting the record, the owner of the business must be separated from the record of the business. That is why in our financials or our statement of financial position, we have drawings, we have capital. Capital is the money given by the owner of the business to the business. So why didn't we just say it is cash? We wouldn't be able to say it is cash because the owner of the business gave the money to the business. The owner is a separate entity from the business, which is what? The business entity. So because there is a business entity, it is important for us to use the convention of accounting principle. Do you see it? Because there is a business entity, it is important to use the conventional method of accounting for this principle, concept. This is how it works. There is a rule that we have to use, which it has to be acceptable because it is an entity. Do we get it? So business entity is what? Separating the accounting records of the owner from the owner. Capital, we know what we have to separate capital. And when the owner of the business takes money from the business or takes stocks from the business, it has to be drawings. So we know that whenever there is drawings, it means that the owner of the business has taken money from the business. And in our cash book, when the owner of the business, when the money is taken from the business for office use, it becomes a contract because it's still within the business. It's not personal use. Do we understand?
Yes.
Second, we go to consistency. It is an accounting principle which says that the business must consistently choose a method of recording its financial records. So, you have to be consistent in whatever method you use or you choose as an accountant. You have to do it consistently. You don't take a record today. Maybe you want to calculate your depreciation. What is depreciation? The wear and tear of an asset. So maybe you have to calculate your depreciation using straight line method. You want to change from straight line method to other methods Next week you want to change again? No. If you have chosen straight line method, you continue with straight line method. If you have chosen diminishing method, you continue with diminishing method. Do we understand? Do we understand this? Yes. So as an accountant, you have to be consistent in whatever method you choose to use. That is the principle of consistency. Is it clear? The third one, duality. We already talked about the double entry system, right? For every debit entry, there must be a corresponding credit entry and vice versa. So that's where duality comes about. I said this is an accounting principle which says that every transaction must have two concepts.
Concepts or aspects?
Aspects, yeah, it's aspects, sorry, it's two aspects, yes. Two aspects. So what are the aspects? The debit and the credit. Is it clear? The fourth one, going concern. Remember I told you about going concern. We said a business must be run as if it will last, it will not end, it will last forever. So in as much as you think that this business will last forever, then accounting principles should also what? Last forever. That is going concern. So whatever records you make as a business, it has to be made on the aspect that it will continue to be forever. Is it clear? That is going concern. Then we have historic cost. All transactions recorded must be done with their initial value. When we talk about initial value, this is what we're talking about. Let's assume this is a house. I bought this house. The value I bought this house, I must record it with it. After buying the house or buying that car, there's going to be a point in time where the value will diminish. But initially, it's not going to diminish. The value you bought the car or whatever you have bought, at that point in time, you record the amount of that thing in your financial statements. After that, whatever happens, then you have to start taking it away. The depreciation will come. Do you understand? But firstly, whenever you buy whatever you buy in terms of assets, you have to record it with the initial price. That is what we mean by historic cost. Historic cost. What you bought right now, the value of it has to be recorded. Then afterwards, whatever happens then, you can. But at the initial stage of your records, you have to record your transaction based on their value that you bought the item. Is it clear? We go to matching principle. I said this implies that all revenue made at the period must be matched against the cost at that period. So if you make revenues now, immediately you have to match it with your cost. So that's why when we are doing our statement or our income statement, we have sales, we less it from purchases. Yes or no? So our sales minus cost of sales immediately. That is what we mean by matching principle or matching concept or accrual matching concept. What does it imply? Immediately you make revenue, you take away your cost at that point in time. Don't take your revenue now and leave your cost till next year. Your accounting situation will not balance. Your profit will be overstated because you forgot to take away your profit, your cost from your cost of sales, your cost of sales from your sales. You will think you've made a huge profit, which is not. Do you understand what matching concept is here? You have to match the revenues made right now with the cost of now. Is it clear? The next one. Materiality. All items may not directly affect the profits or assets of a firm. Can be recorded together. So whatever items you have that's not going to affect your profit or your assets, you can put them in the general ledger. You know, sometimes we have our sales, when we are opening our nominal ledger, we have the sales ledger, we have the sales account, purchases account. These ones will affect our profit or assets. But some will put them together as what? General ledger. When we know that it's not going to affect our profit or assets. Yes. Is it clear? Money measurement principle. This implies that recorded information must be those items that have monetary value. Whatever you are recording in your financial statements or in your accounting records must be those that have monetary value. Not like goodwill. Goodwill is an asset, but it's an intangible asset. Goodwill means your reputation. It's an asset of the business, but it's not monetary. So you cannot record a goodwill in your financial statement or in your statement of financial position because it doesn't have a monetary value. So all items that have monetary value must be recorded in your financial record. Is it clear?
Yes.
Is it clear?
Yes.
We go to prudence. What is prudence? Financial records in terms of profit and asset must not be overstated, while losses and liability must not also be understated. So as an accountant or as a business, don't give more profit than what you have earned. Don't say, oh, we make 1 million profit, whereas you made 800,000 profit. And don't say you made 200,000 loss, whereas you made 500,000 loss. You want to prove good. You want to make people to feel like you are doing better, where you are at a loss. Say it the way it is. That's what we mean by prudence. Do we understand prudence here? You don't overstate your profit. You don't understate your loss. You don't overstate your assets. You don't understate your liabilities. People will do that to make them look like good. Our losses are not much, but it is much. Say it the way it is. That is the principle of prudence. Is it clear?
Yes.
Is it clear, please? And the last one, realization principle. Revenue must not only be recorded when the sales have been passed to the customer. Don't say, oh, we're going to make 10,000 today, and you record it, 10,000 has been made today. Sell first before you make your record. Do you understand? Don't assume that you're going to make 5,000 and immediately you have done your record of 5,000. Before you do your record, the product would have been passed to the customer. That's what we call realization. That means you have realized the revenue before you recorded the revenue.
Yes.
Is it clear?
Yes.
Do you have any question about it?
No.
You can write.